So many women that I talk to know they've got different accounts. They've got some retirement accounts. Maybe they've got one still at an old employer. Maybe they've got an investment account. They got something they inherited from Aunt Myrtle. They got some joint stuff. But it's hard for, I would say, a civilian, a non-financial geeky person to understand the differences between all these accounts and what they mean and the tax treatments and all that. And we've addressed that in some episodes. But today, what we're going to talk about is actually when you're moving accounts. Because guess what, lovely listeners, there's even more complications and things to be aware of in that area. Hey, dear listeners, we need to let you know that Kevin and Stephanie offer investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations to any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Now let's get on with the show. This is Take Back Retirement, the show that's redefining retirement for women. Retirement is an old-fashioned cultural concept. We want to reclaim the word so you can make it your own. I'm Stephanie McCullough, financial planner and founder of Sophia Financial, where our mission is to reduce women's money stress and empower them to make wise, holistic decisions so they can get back to living their best lives. Kevin Gaines is my longtime colleague with deep knowledge in the technical stuff, investments, taxes, and retirement plan rules. He's a little bit geeky and quantitative. I'm a little bit touchy-feely and qualitative. Together, through conversations and interviews, we aim to give you the information and motivation you need to move forward with confidence. We're so glad you're here. Coming to you semi-live from the beautiful West Lakes Office Park in suburban Philadelphia, this is Stephanie McCullough and Kevin Gaines of Sophia Financial and American Financial Management Group. Say hello, Kevin.
Hello, Kevin. As a financial geeky person, it pains me to say that we're not magical when it comes to making these account transfers happen that any rational new client would expect us to do. There's tax laws and regulations to take into account. And as we've covered many, many times, when it comes to the tax code, nothing is simple. They can make it sound as simple as they want to in the headline. You go more than one paragraph into the rule and you're going, what the hell? In addition to that, every custodian or account type, they got their own little, call them nuances, where there could be hidden fees or just things to be aware of when you're trying to shift things around. And then, yes, sometimes, unfortunately, back office glitches happen as well. And there's a couple things clients can do to protect themselves there.
And let's just kind of back up a little bit, right? Like one of the things that Kevin and I were talking about that brought up the idea for this episode is the fact that people move their accounts, people move their investments, people move their money. I mean, I'm sure you've all had the experience of moving banks, changing banks, and what a pain in the butt that can be because maybe you've got direct deposit from work and maybe you've got bills coming out automatically and there's a lot of stuff. But you can move your investment accounts also. You can move your retirement account. You can move just a regular investment account. And I do want to emphasize that because I have met people who did not realize that they could move their investment account, especially maybe something you've inherited from parents. And it's with some quote unquote advisor who's really more of a stockbroker person who doesn't give you the time of day, but you're paying them fees. You can move to a place that you find more aligned with how you want to work, more copacetic, whatever it might be. But there are these kind of just things to be aware of when accounts are moving.
And frankly, just to make it even more quote unquote interesting, different account types, there's different things to be aware of. Some are simpler than others. For example, taxable accounts. And by
what's a taxable account, Kevin?
We're talking something that says individual or joint or, frankly, trust. Something that you have to pay taxes on every year. We are not talking about 401ks, IRAs, Roths.
So people sometimes call this a brokerage account or an investment account or whatever. It's just, it almost, in my thinking, is defined by what it's not. Like Kevin was saying, it's not a retirement account because those retirement accounts, as we've talked about, have special tax rules. This is just your run-of-the-mill investment account. And when we say you pay tax every year, you're going to get something in the mail, usually in the mail, sometimes digitally now in January, February-ish, a 1099 with different letters after it. It tells you how much tax you owe. That's what a taxable account is in our world. And
Correct.
Kevin, could I stop you one more time? You used another word I want to make sure we define for people. What's a custodian?
So a custodian is simply, it's a fancy way of saying the people that hold your money.
Mm-hmm.
So
the company.
Right. The people you see advertised on TV, Fidelity, Schwab, Robinhood, the Wall Street firms, E-Trade, it could be Morgan Stanley, it could be somebody like that.
Mm-hmm.
It's the big name you see on the statement.
So if you're moving a taxable account from one custodian to another custodian, what do we need to think about and be aware of?
So I would say the biggest thing, and it's a misconception that people still have after all these years, even though it hasn't been true for a while, is you don't have to sell everything to move. Several years ago, especially if it was like mutual funds, there was what's called proprietary products. So you were with Vanguard, you were with Morgan Stanley, you invested in mutual funds and it was their mutual funds. It was the Vanguard fund. It was the Morgan Stanley whatever fund. It was Fidelity, whoever. It actually used to be hard to move what was called proprietary product from one custodian to another.
So you couldn't move a Morgan Stanley fund to an account at Fidelity?
Correct.
Because Fidelity just literally didn't have the agreements in place to be able to own it, to hold it for you.
Absolutely.
Yeah.
And so the only way you could move it was to sell it.
Yeah.
Well, okay, it's an easy enough thing to do until tax time comes.
Because we just said these are taxable accounts.
Right.
So if that Morgan Stanley fund has gone up in value from when you purchased it and you have to sell it to move, what happens?
The IRS eyes get really big and they go cha-ching because you now have to pay a capital gains tax.
Mm-hmm.
So, and if it's been a successful investment, that tax bill might be noticeable, shall we say.
Right. Especially if you've held it for a long time or if you inherited it from Great Aunt Myrtle when you were 6, right? And now all of a sudden you're 46 and you want to move it, that could have a large, what we would call an unrealized gain, meaning you haven't sold it, you haven't paid any tax yet, and the IRS eyes get really big.
Right. And now this really hasn't been true really for like a decade and a half, but every so often you see some legacy stuff out there. The custodians didn't used to have to keep track of cost basis. So you would sit back in the old days.
Yeah.
You would sell the stuff. You would have to actually go through all your old statements to figure out how much you actually invested.
Yeah.
So you didn't pay tax on your own money.
Right. That's a pain in the butt. We still occasionally find a client who's got some proprietary thing that can't be moved, but it is rare. Almost everything, what you're saying is you can take that Morgan Stanley fund, move it to a Fidelity account without selling it, which means your cost basis comes over, your unrealized gain comes over. There's no taxable event that happens just because you felt like changing where your money lives.
Correct.
I like it.
So yes. So that's really the big thing with taxable accounts.
So kind of like when you're moving your bank, right? And you've got things set up at your old bank and you need to set them up at the new bank. If you're moving your taxable investment account from one custodian to another, maybe you had it linked to your bank account to put money in or take money out. Maybe you had what we call a systematic investment going on, a periodic investment plan, where you're plopping in $150 a month or something. Any of those things you'll have to set up again at the new custodian. And if you had a designation on the account that's called transfer on death, which is kind of sort of a way to put a beneficiary designation on a account that doesn't actually have a beneficiary, then you want to make sure that gets set up at the new place too.
Yeah, Stephanie, I'm glad you mentioned the new custodian because there is, as we led in the beginning, things our listeners can do to help make sure nothing falls through the cracks. Check what moved over.
Mm-hmm.
Now, the new custodian, yes, they're going to match things up to make sure all of your investments came over the way they thought it did. But check your cost basis.
Mm-hmm.
We were just talking, it didn't used to get tracked. Now it should be, but sometimes glitches happen. The cost basis may not come over or it may come over incorrectly.
Or if it's not there right away, like it can take a few days.
Yes.
The positions might come over and it takes 5 days for the cost basis to come over. So don't panic right away, but you do want that information in there for your own convenience later down the road.
Yeah, I want to do it 24 hours after you see the money show up, but a couple weeks later, yeah, you do want to check sooner than later so you can get things fixed if there is a problem.
And is it a good idea before you close down everything at the old custodian to maybe download some of your statements, print some things for your own records? Because once you're a former client, you might not have access to that info anymore. You're going to be less of a priority.
Right. I think of the old joke from Pretty Woman when Julia Roberts goes in there to shop and she has troubles or whatever. And Richard Gere says, stores aren't nice to people, they're nice to credit cards. Well, the cynical version of me would say, custodians aren't nice to people, they're nice to people's money.
Right.
And if they got your money, they're going to be nice and accommodating. If they don't, they might be a little bit more difficult.
Yeah. The other thing just to be aware of, and it might not happen, but sometimes when you're closing an account at a custodian, they might charge you some kind of account closing fee that they justify as, administrative costs and that kind of stuff. However, that's more common on what we would term a retirement account, which gives Kevin a segue into his favorite topic, retirement accounts and all their rules.
And rules we've got. Yes. And just a quick thing about closing fees. They tend to be more of a nuisance amount as opposed to something very punitive. I mean,
$50,
50, 75, something like that. It's not going to necessarily make or break you.
Right.
But do be aware.
Yeah.
They show up.
The other thing that we've seen sometimes is you've moved the account over, you've moved all the positions over, and then all of a sudden you have $6.73 at the old place. And sometimes a dividend from a position that you moved over hits in the old custodian. And usually they just get swept over, over time. You don't often have to do something. If you've asked them to move everything to the new place, it will move over, but it might take a little bit of time.
Right. I mean, and the old place will continue to send you statements until there's no more activity in the account, even though you've moved it and you've closed it. If that residual dividend or interest payment hits,
right,
it actually will generate a statement, and you'll normally see on the transaction history, it came in and then it left a few days later. But if you get a statement and there's a balance at the end of the month, just ask the question.
Yeah. Okay, Kevin. So if you're moving a retirement account, what else do we need to be aware of? What are the categories of things before we get into the nitty-gritty details? Dear listeners, I'm going to try to spare you from Kevin going too far down the rabbit hole.
I would never do that, would I? So there's really two ways to move money out of your retirement accounts. And it's called trustee-to-trustee transfer, direct transfer, depending on if it's coming from 401k or an IRA. Or you can do it as a rollover. Although 401ks, we'll call it a direct rollover, which is this first category of you fill out a form, you say move money from custodian A to custodian B, and you do nothing else. It all happens automatically. You don't get a check in the mail normally, and you're out of it.
What's that one called again?
So that can be called a direct rollover if it comes from your 401, your retirement plan at work into an IRA. Or if you're just moving from Fidelity to Schwab, then it's just called trustee-to-trustee transfer.
Okay.
Keyword there is transfer. But, the key thing with the transfer is the money is never technically in your possession.
Mm-hmm.
Therefore, the IRS has no problems because you're not getting the money.
Yeah. Yeah.
IRS has problems, or to phrase it more accurately, IRS wants to get paid when you have control of your money.
Right.
So that's why you do this transfer. You can just move the money. You can do it as many times as you want. No problem.
And to kind of just flesh that out a little bit more, what you're talking about in the trustee-to-trustee or rollover out of an employer plan, like literally kind of in the old days, if it was a check, the check is made out to the new custodian for benefit of you.
Yes.
Right? That's what we're talking about. Like the money never goes through your hands. Even if they mail you the check, again, in the old days, you'd get a check in the mail, but it would be made out to Fidelity for benefit of Stephanie, for example.
Correct.
Right?
Not you say to old days, but they actually still mail checks. They still
do it. Yeah, it is crazy. And it can take weeks and weeks in the mail.
But the important thing is, well, like you said, Stephanie, it's paid to the order of custodian FBO, not Stephanie.
Right. So nowadays, very often, and what we like to see, because it's easier, is when it's done electronically. But again, the paperwork you're filling out, if you read it, says that it's literally sending the money to custodian, not to you. Yeah.
Yes.
So Kevin, let's say I've got my IRA. It's either no longer in an employer plan or it was never, right? I just built it up over the years. It's a regular IRA or a Roth IRA, and I want to move it from custodian A to custodian B. What do I have to be aware of there? What's the option I want to do?
You want to do a transfer. And the new custodian or your new advisor is going to be very helpful in this because they're going to want you to do a transfer because it makes their life easier as well. So they're going to give you a form that we call ACAT, which is short for account transfer form. Mm-hmm. It's actually the same form you're going to use if you move your taxable account. It's just moving from one brokerage custodian to another.
Yeah. And sometimes it's not a form. Sometimes it's online. I've
it's
done
online,
both.
Right. Mm-hmm. But yes,
But they'll have different options you can pick, right?
Correct.
And you want to do the transfer or trustee-to-trustee transfer.
And if you have any questions, always ask. Mm-hmm. These companies are going to want to help you.
Right. The new ones who are getting your money.
The older ones, they may throw you a bone and answer a question or two, but they're not going to do it with a smile on their face.
This is true. Okay, good.
Yeah. So the other thing is called the 60-day rollover. With this rollover, you actually get the money first. You get a check made payable to, let's pay Stephanie again. The check is made payable to Stephanie McCullough. No custodian name, no FBO, nothing.
Right.
Just Stephanie McCullough. Mm-hmm. Or they might do a direct wire into your bank. Either way, the money is in an account in your name only.
Yeah. Which, like in the IRS world, you now have it, right? Control of it.
That's your money.
Yeah. Taxes.
Yes. IRS's favorite word. So you got to get it back within 60 days. Okay, fine. So if you do this, the money comes to you.
Into your possession, your legal,
days,
Mm-hmm.
Not 61 days. I'm telling you now, the IRS checks this every damn time.
Uh-huh.
You have 60 days to get that money into another IRA.
Back into an IRA, right? Because we've talked about this, how it's the container, it's the bucket that has the rules. And in this case, in the trustee-to-trustee, it went directly from one IRA bucket to another IRA bucket. But in this case, the way I'm picturing it, it literally left an IRA bucket because it went to your bank account or a check to you. And when that happens, it's a distribution. But there's this exception. There's a rule that if within the 60 days, you get it back into an IRA bucket, you've escaped taxation, right? And is it 60 days from the day they write the check or 60 days from the day I receive it?
From the day you receive it.
Okay. So keep track of these things.
Just because the check is dated June 1st, that's not necessarily when the clock starts.
Okay.
Now, if the IRS really feels like busting your chops, you're going to have to prove when you got the check.
Yeah.
So, as with all things with the IRS, document. So you turn around, you get the money and you put it back into an IRA. You're done.
Anywhere. Doesn't matter where, right?
Correct.
Doesn't have to be the same IRA. Like the whole point is that you're moving it somewhere else.
Yes.
As long as it's in the same type of bucket.
And if you don't, then like where you keep saying, the IRS gets happy. But here's a couple things to watch out for. Maybe it's a small rollover and you don't care that you got to pay income tax on these dollars, as long as you can get it back into the account. Well, a couple things. After that 60 days, you can't put it back.
You're not allowed to put it into an IRA?
You're not allowed to put it back into an IRA.
Ooh, because you're back in the IRA contribution rules that have limits.
Right, because it's no longer an IRA. After 60 days, it's no longer IRA money.
Got it.
Now,
so you don't just pay the tax, you lose the ability to keep it in that tax protected.
Yes,
bucket.
It is out. It is done. You don't want to fall outside of that because the money is no longer IRA. Another trap, if you go outside of that 60 days, if you're under 59 and a half, you're going to pay an additional 10% penalty.
Oh, right.
Unless you have some sort of exception.
Distributions on IRAs before 59 and a half means penalty.
Yeah. So again, and if this is a big check, now in addition to just regular income tax, it's another 10%.
Right. That you didn't want to pay.
If you are over, at the moment, 73, which is the current RMDH.
Required minimum distribution.
And you do this 60-day rollover, problem, you haven't taken your RMD yet. You have to take your RMD before you can do
a distribution.
Which means if you take out $100,000, hypothetically.
Yes.
And your RMD is $10,000, you're only allowed to put $90,000 back in to an IRA. That first $10,000, the first dollar rule says the first dollars that come out of an IRA
are just automatically designated as
satisfies the RMD.
Your required distribution. Okay. So you could get in trouble for putting too much back in, but within the 60 days, you're okay. So Kevin, I do believe I have seen situations where a check was mailed and it was made out to client as opposed to custodian, and client calls like, no, this is an error. This is not what I requested. Please cancel this check and do it correctly. Does that sometimes work?
Yes.
Okay.
Especially if it was a mistake.
Yeah.
Now you fill out the paperwork and say, send me the check. And then you realize, oops, I goofed. They're not going to cancel the check.
Yeah. Yeah.
Most of the time.
Because they've got the paperwork saying
they got the paperwork
what you wanted.
Saying,
okay.
Right. The IRS doesn't like custodians changing things after the fact, because then custodians are going to get in trouble. They're not going to risk.
Right. They've got whole big legal departments telling them what they can and can't do.
Absolutely.
Okay. So Kevin, now, I mean, it's been quite a few years now, but there are two types of IRAs in the world. There are traditional and there are Roth, thanks to Senator Roth from Delaware, our neighbor. So what kind of issues do we have to be aware of there, right? I mean, now we've got two kind of subtypes of buckets of IRA money. And what could go wrong? So
what could go right is we've already covered what you do for a Roth. Same rules that apply to a traditional IRA.
Yeah.
Or your pre-tax, which is you do the transfer or you do a 60-day rollover.
Yes.
Here's where the problem can arise is, and this is going to be a custodial error most of the time. It could be the client issue where they just got confused with account numbers because there's a lot of stuff moving around.
Right.
Your traditional money goes into a Roth or your Roth goes into a traditional IRA.
Whoopsie.
Now, all of a sudden, especially if you don't catch this stuff, it's going to be a problem because now all of a sudden you have an illegal Roth conversion. If you put your traditional IRA into a Roth and you don't pay taxes on it, you lose, or you got to get double taxed if you put your Roth money into the pre-tax.
Right. Because the whole thing about Roth is you never owe tax on it again, as long as you follow the rules.
And it's a pain. even if it is a custodian error and everybody appeals to the IRS and the IRS says, okay, yes, you can move the stuff back around.
Yeah.
It's still a lot of time and effort.
Right.
And if it's your mistake, I hate to say it, most of the time you're SOL.
Yeah.
I mean, it's just, you're stuck. You've now made an excess contribution, which has its own issues, or you've taken a disbursement.
Right.
So you've lost that. You now have to pay taxes on these dollars that you now have to back out of another account, which it just creates a huge mess.
Well, and I'll tell you where I've seen the danger come up, right? We had a client retire from a big company. He'd had a 401k there for, 40 years. He had 3 different types of money in his 401k. He had traditional pre-tax. He had Roth money, because he listened to our advice and was doing that later in his career. And then he also had after-tax money, which people don't do so much anymore, but it was a thing. And now all 3 of those have different treatments. And I'll tell you, when the check came in, because they got mailed to our office, it was hard to tell on the checks which was which.
Yeah.
It wasn't explicitly clear. We had to go back and triple check and talk to the retirement plan to make sure we were treating each check the right way.
Yes. And it wasn't, I mean, I remember all those phone calls that had to keep getting made. It's like, are you sure? Are you sure? And yeah, that's a problem. And that actually leads to another point. This after-tax dollars in a traditional account, whether it's traditional 401k or traditional IRA, this is basis. You've paid tax on these dollars. You don't want to pay tax on these dollars again.
Okay, let's pause and explain to people what after-tax retirement contributions even are, because we don't do them anymore, but you might have them from old days.
Well, and you could still have them. There's provisions in the tax code for a workplace retirement account, 401k, 403b. The limit that everybody hears about, this is the most you can put in your 401k in a year.
Right.
Which right now, depending on your age, is $20-some thousand. But there's actually a maximum limit that's, again, depending on how old you are and everything, is like $60,000, $70,000, or actually $70,000, $80,000 now. It keeps changing every year, which is a total max. And that includes your employer match.
Okay.
And if the plan allows it, you can contribute additional dollars. You don't get the deduction this year. You have to pay tax on it, but you're still allowed to put it in your 401k.
Not Roth.
Not
but
Roth.
This would be what we're calling after tax.
Yes.
Because you didn't get a deduction for that money. Why would you want to ever do that?
Because you just want to save more dollars in a tax preferred account.
Mm-hmm.
There's actually some other quirky reasons. We're not going there as much.
We're not going there. We've already gone too far down.
If it doesn't show up on the video, Stephanie's eyes just got really big. And she goes, oh my God, Kevin's going to go into, I won't even say the name.
Please no.
I mean, so that's one way. The other way you do it is in your IRA. If your income is high enough, you're not allowed to contribute to a Roth. You can make a conversion, but you can't contribute.
Right.
And you won't be allowed to deduct the IRA contribution.
Right.
But you still want to put money in the IRA. So you put it in after tax.
Mm-hmm.
Perfectly legal. It's going to grow tax deferred. And I think we've even talked about the pro rata rule before. When you start taking the money out, you have to allocate a percentage.
Yeah.
But you want to know what that after tax dollar amount is, so you don't pay taxes twice.
Right. So all the point of this long detour was to say, keep your records, keep track of this stuff. Is it enough to just keep your tax return? Like, would the tax return have those records?
Actually, the 5498.
The 5498, which is not required for your tax return.
Which is not required to be filed with your tax returns, but you do get it every year. This is like probably the most important tax document nobody talks about.
Okay. And just to back up again, I said in January, February, you're going to get a 1099 from a custodian for a taxable account. A 5498 is the thing you get every year, usually even after the tax deadline, it feels like.
Right.
But it's from the custodian about your IRAs. And what does it tell us?
It tells you the account value at the end of the year. It shows how the dollars that came in.
Mm-hmm.
So you can use this. This is also really important on keeping track of your Roth contributions and conversion amounts as well. I think they call it an information document.
Okay. So this is really good to keep with records. And I'm thinking to myself, oh, shoot, I got to go make sure I have all mine. Because nobody talks about it.
No.
You think, oh, you don't need to give it to your accountant. Therefore, it's not important. I can ditch it. Not true.
Yeah. I mean, most accountants, they say they don't need it, but you still want to give it to them so they have it. Because, I mean, if they're tracking your stuff year after year after year, they're going to want to know this stuff eventually anyway.
This is a good point. You're going to need to reference it, most likely.
Yes. And plus, it gives you a second place to keep it safe in case you lose your copy of it.
Most accountants anymore have an online portal, right? So at least you can go back into the portal and find it.
Absolutely.
It's a good way to organize. Okay, we've gone pretty far afield. So let's say we've talked about moving taxable accounts. We've talked about moving retirement accounts. What are some other things that fall in this category of you want to move your investments from one place to another that we haven't touched on yet?
The other danger with taking a regular rollover or a distribution out of your workplace retirement account, again, 401k, 403b, one of those, is if you try to transfer your workplace retirement account, you leave job A, you're going to go to job B.
Mm-hmm.
And you're taking
retirement.
You're taking your old retirement account and you're just going to say, send me a check, send Stephanie McCullough a check, and I'll put it in my IRA, or I'll give it to my new 401k to put it in.
Which, as we pointed out, is not the ideal way to do it, because then you got the 60 days. But you're saying there's another issue.
You're allowed, perfectly legal. But for the last, call it for almost 40 years now, the plan has to, by law, withhold 20% of the amount you take and send it to the IRS.
Mm-hmm.
Well, when you file your taxes, depending on how your tax bill, that counts as taxes paid. So it's either used to reduce your tax bill or get you a bigger refund. Problem is, it's a distribution. So it's taxable income, regardless of how old you are. And again, if you're under 59 and a half and you do this 20%, even though you had no say over it getting withheld, still counts as an early distribution.
So when you say it's a distribution, the withholding amount is a distribution. So you request the check, you get 80%, you put the 80% in your IRA, but the 20% that went to the IRS is actually also a distribution.
Correct.
On its own. So the fact, I'm putting it all together, because that 20% didn't end up in an IRA bucket, therefore it is a distribution, right? Because we said if it goes from IRA bucket to IRA bucket within 60 days, it's not a distribution. But the one that went to the IRS isn't going into an IRA. So you owe tax on the amount that you paid for taxes, which is one of those weird meta things, and also potentially 10% penalty.
Exactamundo.
Woo!
Now, here's the silver lining. They don't care. The IRS, in this situation, the IRS doesn't care where the dollars come from to go into your IRA from your 401k. So you take that $100,000, you lose $20,000 to taxes, you're ready to put $80,000 into your IRA.
Right.
If you have $20,000 laying around, you can take that $20,000. So it's up to make it a whole $100,000. And
so it doesn't have to be the same dollars.
Correct.
Okay.
So there, like I said, there is an out, but you know what? Had you just done a direct rollover, you wouldn't have to worry about any of this.
Yeah. It's good that Kevin knows this stuff, because there are way too many rules and little nitpicky things and itty-bitty hiccups and road bumps and speed traps where you can really get caught up. Which is why when Kevin suggested this topic, I was like, come on, really? This is not a full episode, and it has been a full episode.
Well, I mean, and here's the thing. I mean, twice a year I go to a retirement conference, and every year...
Okay, it's not even a retirement conference, people. It's a rules on retirement accounts conference.
Yeah. And there's always, without fail, there's always at least one session talking about beneficiaries, and there's always one session talking about transfers and rollovers and such. And the reason is these rules can get fairly complicated, and a lot of professionals, financial geeky types, get it wrong sometimes. It happens.
And you always come back with new stories of actual real people that have gotten bitten by these rules as cautionary tales.
And Stephanie, I know we're kind of running long here, but there is like one special thing we should touch on, which is annuities specifically, although it's any type of investment that has what's called a surrender period.
Okay, yes.
To it. This is something separate from the wrapper that it's in. You can have these in a taxable account or you can have them in your IRA, but the actual investment itself you have to hold for a certain amount of time, or the company's going to charge you for getting out of it early.
Yes. So this is a case where, maybe you purchased an annuity as an option for your IRA, or not even in an IRA. The interesting thing is sometimes you hold it directly with the insurance company. Sometimes it's held inside of an account at a custodian. I've seen both ways. So that's just another type of investment that you might own that you want to be aware of, double check. If you're moving it, you can keep the same annuity and move it from one place to another. You can even change, insurance agents from one to another. But if you're going to try to move the cash out of the annuity to another product, you want to read the fine print really carefully.
Right. And it's not just a surrender penalty. Also, it's even taxable annuities. They're not in IRAs. They have a 59 and a half age you have to be aware of. So again,
whole nother layer, which we're not going to go deep into because we're not experts, but
I'm out.
We know enough that you got to ask, you got to check, you got to triple check on all those things.
Yes.
So we're not trying to dissuade you from moving where your investments are. Again, you don't want to be stuck somewhere that you're just not vibing with, that you feel like they're not listening to you, they're not giving you the help they want. It's pretty simple to move your money. It's easy, but it's not simple. You want to make sure you tick all the boxes correctly, at least be aware that these things exist. As we always say, don't have to remember every detail. Remember there's things to go back and look up the rules on when you're doing these things.
And again, whether it's a 1-800 number or an advisor, talk with them, be very clear where this money was, where you think it's going to.
And if they don't seem like they understand that this is an important area to be aware of, maybe try to talk to their manager or somebody else.
Yes. Yeah. I mean, there's going to be somebody who knows what's going on at the other end. Hopefully it's the person you're working with. It makes things a lot easier.
I mean, accountants don't always know this stuff either. They're the tax experts, but they don't always know the intricacies of the rules on the tax side.
Because really we're overlapping operations with tax rules, and it's hard to find somebody who knows both sides well enough to say, hey, this is how we want to do it. Yep.
Definitely took me years of doing this work and now I know what I know and what I need to ask Kevin about. Dear listeners, we hope you found this useful. We'll talk to you next time. It's goodbye from me.
And it's goodbye from her.
Be sure to subscribe to the show and please share it with your friends. Show notes and more information available at takebackretirement.com. Huge thanks for the original music by the one and only Raymond Loewy through New Math in New York. See you next time.
Investment advice offered through Private Advisor Group, LLC, a registered investment advisor. Private Advisor Group, American Financial Management Group, and Sophia Financial are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. This information is not intended to be a substitute for individualized tax advice. Please consult your tax advisor regarding your specific situation.